Hello everybody, welcome to our Fitch Learning. Our session will be getting to grips with key financial reporting and analysis topic area. My name is Peter Menzies and I'm one of the instructors in the London office of Fitch Learning. And a welcome to all of you wherever you are joining us from around the world. And what I'm going to be doing for you in the next hour or so is essentially going through the main aspects of financial accounting in terms of use of the calculator, the CFA Level 1 exam, and also conceptual points which are important for you to be able to answer your questions come this summer paper. So it's a welcome to all of you, and I hope you can hear me and what I'll be writing as well see clearly on your screens. And in terms of any questions you might have, what I'll try and do is where I get a chance to address any questions during the session, I will do so, and of course at the end of the session as well we can look at those questions if you have any as well. So there we go. We'll just about to get off to running here. As you can see, we've got a selection of key slides which we, in every case, guys, we title everything what we're doing. We're showing exactly what we're going through from the official CFA exam readings. So as you can see here, this is essentially study session 8, which, as you know, is a section within the syllabus, which this deals with accounting. FR&A, you can see there the title Inventories, Long-Lived Assets, Taxes and Liabilities. Technically non-current, so long-term liabilities. My focus with you in the next hour or so is going to be on that, non-current, long-term. So we're thinking as analysts, we're focusing on a company's, for example, bonds that they may have issued, what types of bonds are they, and how is that bond accounted for, is going to make a difference to the company's, of course, leverage or gearing position on its balance sheet, and how it services that debt would be seen through things like its interest, of course, on its payments to its bondholders. So interest expense will also be, of course, a key component in terms of its profits. So we're going to be looking at the balance sheet liability for things like bonds, and also the income statement profit as well. Also, companies, of course, could be using lease contracts, which although technically are a sort of rental contract, as analysts and as accounting as well, you're supposed to look at long-term leases as really a type of debt. A company is promising to pay lease payments which can be seen as a type of interest payment, and so we account for them rather the same as a bond. So we'll be looking at that. As you can see, we do put down the learning outcome statements for this reading. You can read through that on screen, everybody, just to see what the key command words is the right phrase here. So you see determine, describe, explain. This is what we have to be able to do for the debt. So we'll be doing that, and just going through, there are some calculative losses as well. Obviously, you'd want to make sure that you can calculate whatever you need to. So at the end of the session, we were looking at key ratios, which will be looking at leverage and coverage, which means the ability to pay the debt back, the ability to service the debt. These ratios are key for any borrower. Okay, so if we're all ready, guys, then we're going to get started. Now, the first thing I'd like to do is to address this issue about bonds payable. If you've already studied bonds, generally you'll know what a bond is, but it may or may not be clear. So what I'll do is just do an opening sort of summary of the bond issuer. A bond issuer can be, of course, governments, it can be municipals, it can be companies. We are focusing on companies at the moment. So a bond issuer, a company, is looking to raise money in the debt markets. It sells and issues a bond to its investor base. Now, those investors typically for bonds will be institutions, as opposed to retail customers. But bonds sold to investors, which enables them to raise debt or capital proceeds, cash proceeds. Now, these cash proceeds are calculated as the present value of future payments. Now, as you may well already know, when we are valuing a bond, we use discounted cash flow techniques, So we say the present value of all future payments is the correct way to price a bond. So PV of future cash flows. Now this future cash, as we will see, will be based upon things like your coupon payment that you're making, which is really your interest payment, and indeed your capital repayment, which is known as the par value. Now, also wanting to look at what is in fact the way to discount these things. The present value payment, or the present value calculation, is based upon the yield to maturity. So we'll be focusing, everybody, on how we can use the yield of a bond to firstly price a bond, but also to work out our servicing costs during the life of the bond, which will be our interest expense. I'll be showing you in a moment what's called the amortized cost method, which uses the yield to maturity at issuance. Okay. Now, in terms of a balance sheet, what I like to do is just to write out a balance sheet sort of formula, which I'm sure you're familiar. If I write letters A, L, and E, assets equals liabilities plus equity, and then we would simply say that of course, the asset column, if you like, is going to increase from a bond issuance, because that's, of course, the cash that has been raised, the proceeds, so to speak. And in terms of a liability, well, we have debt, capital, the bond. We can say bond payable. We can say, yeah, it's the debt. So that's our opening. Now, in terms of, guys, discounted cash flows, what we need to remember is what the bond's price will be seen relative to its legal or par value. Essentially, we have a coupon rate the bond is paying. We have a yield which the investors want to receive. If the coupon the bond pays is equal to the yield the investors are happy to receive, then there is no discrepancy in coupon and yield, and the bond is issued at par value. We say the coupon is neither excessive, the coupon is neither deficient. The coupon is exactly what is required. But if the coupon is deficient, in the sense that it's less than what is required, the bond is issued at a discount, which reflects the fact that the bond is not as valuable as indeed the par value states it is, because the coupon is not effectively good enough. However, if the coupon is excessive to the yield, that means the bond essentially is rich and valuable compared to its par, and the bond is issued at a premium. So just some basics, guys, we should be familiar with whether a bond will be issued at par or not. Purely depends on how the yield compares to the coupon rate at issuance. And of course, that's also true for secondary market valuation. Trading-wise, yields change, the coupon doesn't. Therefore, the price will change accordingly. Now, in terms of key thing, guys, here, the income statement. If I write IS there for short, income statement, the interest expense, so I'm showing you guys, is one of the deductions we will make before we get to our pre-tax profits, so earnings before tax. Interest expense is calculated based upon the yield as of the issuance date. So in any given period, we'll say the YTM, the yield to maturity at issuance, is used, and you multiply that by the opening liability, the opening position of the bond payable on a balance sheet. And as we'll see in a moment, that's how you work out your interest expense. Now, please note that you always stick with the yield as of the issuance date. If we stick with that, you'll automatically amortize or remove any discounts the bond might have at issuance, or any premiums the bond might have had at issuance, automatically will be removed over the time of the bond. We must stick with the yield at issuance. And so as you can see, it'll be a case of the interest expense reflects coupons plus the discount. It's a plus discount, guys, because we want to remove the discount. Or if it's a premium that you've got for the bond, it'll be minus the premium. Okay, so amortizing that. That's why we say the interest expense reflects the true cost of the bond. Right? Interest and capital. Interest and capital. Now, as we'll no doubt as practice, a few questions right now coming up, but I want to just show you a sort of pro forma what we need to look at. If you want to work out the bond payable amount at any given time, you want to know how to go from the opening position, so opening bond payable, to the closing position or ending position. Opening and ending, opening and closing, whichever you want to use there. You want to know how to do it. Now, the correct methodology, guys, would be to start with your opening liability, which of course could be the issuance proceeds. At the very beginning it would be, but even on any given period of date after that, we say add on, so plus the interest expense. Okay, so add on the interest. Now, as I've just mentioned, the interest is calculated as opening liability times the yield at issuance. So we must stick with that going forward now. Opening liability and then multiply by yield at issuance. But then you subtract the coupons paid in the period. Now, coupons, guys, are essentially simple interest on a bond. So you'll just have the coupon rate, which will be explicitly told to us, and we'll multiply that by the bond's par value. So that's a sense of why we call, of course, it fixed income, of course, minus the coupons. Now, this does assume, guys, that coupons are paid in arrears. Coupons are paid at the end of the period, which is generally the case. So the interest accrues first on the debt, and then the coupon comes off because you paid at the end of the period. And that, overall, guys, we will actually amortize. So if you go from opening to closing position there, by adding and subtracting these amounts, you will amortize, if I use the phrase here, the PRN, the acronym for principal. You amortize the principal by making these adjustments. And that, of course, could be a discount being amortized, so the bond moves closer but higher, of course, than to par value. Or it could be amortizing a premium, in which case the bond reduces in value down to par. Okay, so that's, guys, what's coming up for us. And we're going to practice a question now, which is on a bond issued at a discount. Okay, so if you've got your financial calculators at the ready, everybody, I'm using the BAII Plus Texas Instruments calculator, which will be referred to here. So first of all, when you start out, guys, I guess you'd want to make sure that you clear any of your old data from your time value money keys. So you press the second button on the top left-hand corner, and you press the FV button. That should clear, as it says there, clear time value of money, which I think is definitely the right thing to do first before we start. Okay. Now the next thing is, as the coupon rate is given, 8%, we can see. That's an annualized number. And that is 8% of what? That's 8% of the bond's par value. Please note the par or face value of the debt is $40,000. So already we can compute the coupon as being 8% multiplied by 40,000. Now, we would have to check what kind of coupon frequency is given here, but as you can see, we're keeping things simple. It's an annual coupon. There's no need to divide by 2, for example, to make it semi-annual, or divide by 4 to make it quarterly. We just need to know the annual payment is 8% of 40,000. And if we check, I believe you are getting 3,200. So that is the coupon, but that is essentially, guys, the annuity. And so on a calculator, we'd call that the PMT, the payment. The equal cash flows that you'll be getting of, across time. The payment is that. Now, the market interest rate given in the next statement is actually whatever the current yield, the yield on the bond is. So the yield to maturity, the market interest rate, that's the yield to maturity currently as of the issuance date. You can see it's 9%. Notice that because the yield is more than the coupon, essentially the coupon is deficient and the market will be paying less than par value for this bond. Okay, so here we go, everybody. We're going to do the pricing now. To work out the initial receipt for the issuer, we're going to take the present value of all the cash flows using the market yield to maturity. Okay, so here we go. First of all, guys, we note the time period of the bond is 3 years. So we'll apply 3N. We note the discount rate, the IY here. So the yield to maturity, folks, is the interest or the yield that the investors require. So IY is 9. So number first, then the key, IY. The coupon is, as we say, 3,200. We've already worked it out, but there it is. 3,200 is the annuity, is the payment. And 40,000, okay, there is actually the future value of the bond. It's effectively the ending value of a bond is its par value. We say a bond will be pulled to par at maturity because there will be no coupons left. The bond is simply worth its par value. And that's it. So if we end up all that, guys, all the cash flows are inputted, FV. We're now computing for the present value. So compute PV. Okay, so see what folks you got there. You compare notes. I believe you're getting 38,987. Thereabouts. Yeah, we'll keep things simple here. Rounded answer. Now, don't forget the basics. We're saying on the issuer's balance sheet, the first thing that they would have, of course, is an influx of cash proceeds from a bond issuance. So we note the cash has gone up. And we also record the bond, the bond payable. So let's put that in, everybody. Let's make sure we're happy. 38,987 of cash, 38,987 of bond. It's a match, of course, on the left and right hand side here. There's no need to record anything in the income statement yet. This is, okay, at issuance. This is the balance sheet effect at issuance. But we also need to show the interest effect of the income statement impact, right? So the interest expense, and how the liability will change over a 3-year period. Okay, so to help us do this, we've already got something prepared for you. Happy to move through and turn through here. We're going to see basically what is called the amortized cost method. The amortized cost method for accounting for bonds. Okay, folks, the term or the phrase used, the amortized cost method. This is specifically for the liability, yes, the bond payable we're focusing on, not the assets, not the cash, nothing, just the bond payable itself. Now, look at that. The opening balance as of period 1 is the issuance proceeds. So that's where that number comes from. We already worked out, didn't we? The issuance proceeds is 38,987. And the next thing you've got to do is fill, or at least explain, I think, the numbers that we see in period 1. Of course, guys, period 1 here does mean the first year because all the periods are annual in this example. Now, the interest expense is supposed to be then the opening balance, so 38,987, and you are to multiply this by the yield at issuance. Now notice, guys, the yield was 9%. So the number that we see should be simply 9% of 38,987. You can check to see that that does work. So again, we're just showing that it all does fit in there. So we have rounded the number, of course, but it's approximately right, isn't it? 9% of 38,987 is 3,509. That would be accruing on the liability. That would be accruing or adding to your balance sheet liability. But then you would subtract the cash payment. Notice, guys, that's of course just your coupon. So the coupon is a payment. Notice it reduces the liability. So we're adding one thing, we're subtracting the other. And by doing that, we should be getting your closing balance sheet amount. So your ending amount is 39,296. Double check you're happy with that. But also, guys, notice what your principal is. Far right PRN, which is being amortized. Yeah? So for the first year, what have you done to your liability? You've grown it by 3,509, and then you've taken away 3,200. the net effect of doing that should be to have grown, right, your liability by plus 309. That's the effect of the amortization. Yeah? So 309, guys, is your amortized discount, principal amortized, 309. Now, notice, folks, that the closing balance there is then going to be, for the first year, closing balance is the same as your opening balance for the second year. We just go straight on and say for year 2, open with the same amount that you closed year 1. And follow the rules. Okay, now we need to fill in the gaps, guys. So 9% of the opening balance, we're still sticking with 9%. Let's do that. 39,296 times 9% is going to give us the interest expense for year 2. Should we take a rounded answer? 3537. How about that? 3537, rounded answer. That accrues on the debt, and then you will subtract the cash payment, which we don't even have to do a calculation. It's the same as the coupon in the first year. It's a fixed amount. It's 3,200 again. So what's happened then? If we take the opening balance, we add 3537, we subtract 3200. What is your closing balance then? The end of year 2. Can we agree on 39,633? And also, check what your amortized principal is. Check what's happened. So you've added 3537 and you subtract 3,200. Overall, this amount has gone up again by 337. That's the amortized principal. Okay, so guys, hopefully you get the idea now. We can finish things off. We're going to end with year 3, of course. We open year 3 with the same number you finish year 2. And that's it now. Finishing off, let's do 9% yet again of this balance. Will give us your interest expense. Double check that there. 39,633 times 9%. We'll take a rounded answer. How about that? 3567. And then, of course, removing lastly again the coupon, and we're done. And what do we expect to happen? We expect the bond to be pulled to par. We expect the bond to converge to its par value as of the last date. And it does, right? It does. It goes to 40,000, the par value. And this then amortizes the remaining discount that was there. So we check there. So you added 3567 versus taking off 3,200. So overall, you grew the liability by 367. And that's it, right? So the closing balance is as expected, $40,000. Now notice, guys, that obviously this then allows the issuer as of, redemption, when they redeem the bond as of the date of redemption or, buying back the debt, we say, yes, the key aspect is you'll have to fork out 40,000 of cash. So cash will go down 40,000, but also you remove the bond. The bond is also worth, of course, 40,000 par value, and that will be your last account, or last adjustment. Right? Finished. By the way, also, guys, notice that what we have done is show that the interest expense essentially does reflect the true cost of debt for the issuer. If we have a look at the interest expense column, we just have a look at this one here, guys, interest expense column, we can see that the total, okay, if I total this up here, the column which is reading interest expense, in the first year, 3,509. In the second year, 3,537. Third year, 3,567. Now, all of these amounts total to 10,613. Now, why is that important? Well, the coupons themselves, the actual cash, if you like, interest payments, was 3,200 3 times over. Right? I'll just say times 3, which was giving us 9,600. So what I'm saying is, in terms of interest paid, which is the cash payment, remember, this is interest paid. Your interest paid is 9,600, but your interest expense is totaling 10,613. And as I'm sure you probably already guessed, the reason is because 10,613 reflects the 9,600 element, but also reflects the capital which you had to repay as well. So that's the difference between 40,000 which you paid back and the 38,000 approximately, or 39,000 approximately, which you actually borrowed. And that's the idea, you see. So true cost of debt, total interest expense, okay, equals total coupons and plus, of course, all of the amortized discount. As we saw earlier, that would be true to reflect the true cost of that. So hopefully, everyone, this all then is bringing together all the points we made a moment ago, a few slides ago. But of course, you know, doing it manually helps us understand what's going on. But we don't have time to do this, of course, on an exam day. We need a shortcut. So let's talk about shortcuts. I've got some solutions there. But shortcuts. Now, as if you haven't used this already, this is a good time to practice this. I want you to press the second button and then the button which gives you access to the amortization function, which is the PV button. So second PV, everyone, will give you access to amortization. Now, you must not have cleared any of your data from our example, otherwise we won't have anything to analyze. But if you press second amort, the display shows P1 equals. Now, P1 equals means the starting time. So starting time period is what P1 stands for. Now, by default, typically that is starting in the first period. Now, yours might not say that, but just to be on the same page, if not, make it say that. So press 1 and press enter. This means that you want to start your analysis from the beginning of year 1. If you then press the down arrow, we get P2. Now P2 is actually then for ending time period. End time period. Confusingly, people think, of course, P1 is period 1 and P2 is period 2, but it is not the case. Right? Starting and ending is what they really mean. So starting period is 1 for us. Ending time period, you can also make 1 if you like. That will focus on the same things. So 1 and enter. Now the analysis is for year 1. All right? Everything we're going to see is looking at year 1 data. So you press the down arrow again. The first thing you'll see, I guess, guys, will be balance. Now balance means ending balance. Okay, ending balance on the first year. Now, we actually did it manually, but if you want to just double check, for the first year, we were getting, as you can see, 39,296. That's a rounded number, though. The calculator function gives us it more accurately. 39,296.36, you know, a little more data, a little more accuracy. If you press the down arrow, it tells you PRN. PRN, guys, amortized. What was the amortized principal in year 1? Well, again, if we double check, we approximately worked out as being plus 309, right? Just over here. So 309, and that's exactly what the calculator tells you. 309 approximately. And lastly, the most obvious point to note is interest expense. What was the expense in the first year? And that was, remember, the 9% of the opening balance. We were doing that. And just to double check, yes, that was roughly 3,509. There, the calculator, of course, being more, giving us more accuracy. But there we go. Hope that's all right. So you can see how efficient this is just by pressing those arrows. And that's it. So you get these 3 items basically. Balance at the end, principal amortized, interest expense, whatever period you want. Now, if I amend or adjust, guys, my P1s and P2s for year 2, I basically have to set both P1 and P2 to equal 2. So I go from the start to the end of year 2. If I want to do year 3, no surprise, I set P1 to 3 and P2 to 3. So analysing from the start to the end of year 3. Just to say, folks, that you may not use the Texas calculator. You may be using the Hewlett-Packard calculator. If you are, please continue to do so. There's nothing in the sense of saying the Texas is better than the HP. Both are official calculators for the exam. Texas may be more commonly used, but both have their advantages. So no, absolutely not. The HP calculator is absolutely perfectly fine, just that I'm having to use a Texas myself today. I have a question there about the HP. Nothing wrong with either of them. They have their advantages in both, certain cases. One's better than the other. Guys, they're P1s and P2s set accordingly. And of course, if you want to analyze, guys, the entire period, so you go from the beginning to the end of the bond's life, of course, for the entire period, for the total, you would just set P1 equaling 1 and P2 equaling 3. And of course, therefore, you will be analysing everything. Right from the start of year 1, right to the end of year 3. You'll get all the total numbers. Balance, of course, will be 40,000 at the end. Principal will be all the amortized principal. Interest will be all the interest expense. Okay, so there we go. I hope that's of some use to you. If you haven't already practiced this, very good time saving. Shall we just try very briefly one more? I don't think we had to say too much more about this now, but there is a bond issued at premium as our next example. And, guys, obviously it's the same bond actually. Annual coupons, face value 40,000, coupon rate still 8% there. But what we've changed now is that the actual yield the market wants is different. So as we can see, the market now wants only 6%, right? So the coupon is looking rich now. Right? And as therefore we can say, you just need to amend, guys, then your IY. Just change your IY to now read 6. And let's recompute the present value of the bond. And we now see the bond should be valued at a premium to par value. Basically a rich coupon. So I hope that's okay, guys, getting something like 42,138. And of course, this will be the initial cash proceeds, etc. Right? We know how to write that. At issuance, cash up, and of course, bond liability up, both by the same amount of 42,000. But as before, we are going to use the amortized cost method, so the bond should, of course, converge to 40,000 over its life. The way to do that is to use this method. Okay, so this is the balance sheet at the date of issuance. And unsurprisingly, we would start our numbers at the issuance date and go forward from there. But we have, guys, got a completed table for you, just to say that, of course, you can use the function. And I think that's probably the right idea, isn't it, really? If you were doing this, you wouldn't be filling in tables. But be ready. So I think just essentially thing here, of course, if you're doing this manually, you would notice, as always, to go from the opening balance to the interest expense, you're going to multiply by the YTM as of issuance. And that hasn't changed. That's still... that is the example here. We're using 6% as opposed to 9 earlier. So we're using 6% for everything, and that should then give you these numbers here. Okay, and of course the cash payment is unchanged from before. It's the coupon rate multiplied by the par value, which is the same as before. Okay, so that's just noticing as we go through there. This time, of course, your bond is reducing in value over time. It finishes at 40,000 again, but in this case, the interest expense as a total, as you can see, is not as much as the coupons. The coupons, that's because, of course, the total interest expense is equal to the coupons, but in this case, minus minus the amortized premium. Essentially, the issuer is repaying less than they borrowed. So it's a sense of a saving in that sense, in a sense, really. But the amortized premium, guys, they're the difference between 42,000 and 138 versus 40,000. So that explains the difference. Okay, hope that's all right. So you can, guys, play around with that, and certainly you could use the calculator amortizing function just by pressing second and PV, and you could sort of course go through that. We've shown again the calculator method. Okay, hope that's okay there. So P1 equaling and P2 equaling, same idea, and same, of course, analysis. You can do balance, principal, and interest. Now, everybody, if you're happy with what we've done so far, then we can transfer these skills into something related. And that area, guys, is leases. Specifically, we're going to focus on finance leases. But before we get into the actual detail, let's just have a look at some narrative introduction. Now, guys, in terms of a contract called a lease, you have to be familiar with the jargon of what's called a lessor and a lessee. Now, the lessor is the one who owns an asset. Okay, so they are the legal owner of something. That might be machinery, right, for example, capital equipment. Let's say it's a mining company. They own the actual mining equipment. But they are happy to rent it out, so to speak. Now, the party which needs the asset for a time period is called the lessee. Now, they will be not the legal owner, not at all, but essentially the asset will be with them for a temporary time frame. The asset will be them for a temporary time frame. Should we say asset transfers to the lessee, just temporary though, and in return the lessee will be making lease payments. Now, lease payments essentially are a type of annuity, equal, regular amounts. The question is, how does the lessee, and of course also the lessor, account for this transaction? Well, as we'll see here, the question mark is the lessee regarded as the economic owner? They are not the legal owner, but are they considered to be the economic owner? And the point, ladies and gentlemen, is, do they have the asset for enough time that they basically absorb all of the economic benefits? Because if that's the case, even though they don't necessarily have legal title, they absorb all the benefits. They're as good as the person who owns the asset. Okay, so we see here a finance lease, which is also known as a capital lease, is recognized on the balance sheet. Recognized on the balance sheet. Now, recognized means, we do a simple note here. Recognized means on the asset side, we have the leased asset. Yeah. So, as if you bought it, it's yours. And on the liability side, we have the actual commitment to pay a lease, the lease payable. So leased asset and lease payable both are on the balance sheet. Now, they are both of the same amount. You see, the leased asset is equal to the PV of the lease. Okay, and the lease payable is also the PV of the lease. So in that case, yes. Are you the economic owner? Yes, you are. You account it for on the balance sheet, recognized. Okay, so we'll make a note there. Finance lease, you are the lessee, is regarded as economic owner. But that's not true for the next one. The finance lease, not the case. Sorry, the operating lease, not the case. The operating lease, the lessor is still regarded as the economic owner. So in other words, generally most of the benefits are assumed to still flow to the lessor, and so it's purely like a short-term rental contract. And therefore for the lessee, they don't recognize any asset or liability on the balance sheet. All they do is they show operating cost, which is the rent, the actual lease payments. Okay, so rental expense, which means the operating expenses, operating cost, operating expense, is recognized in the income statement. And by the way, of course, in terms of cash as well, it would be operating cash flow, which is recognized in the cash from operations. Now, the idea, guys, generally for accounting is to prove that your lease is not a finance lease. And so the International Financial Standards, the IFRS, have designed a criteria for recognition of a finance lease. Now, please note that any one of these will be sufficient to justify it to be a finance lease. Okay, any one of these. So the first point there, ownership transfers. Transfer ownership of the asset to the lessee. Okay, so that's a pretty basic one, isn't it, really? The leaseor is legal title now, but legal title will transfer to the lessee over the term of the lease. Just saying legal title there will transfer. Now, even if that transfer of legal title happens in the future, you will have to assume ownership on the balance sheet now as a lessee. Okay? Alternatively, we say there is an option to buy the asset for the lessee. So think of it like a call option, and the call option is assumed to be in the money because the strike price, right? You have like a strike price on an option, and the call strike, if you like, is less than fair value. So that means you can assume that the option will be exercised, in which case behave as the owner then. You will exercise at some point, the lessee is the owner. Alternatively, the lease term is just significant. Now, we note, guys, it says they're major part of the economic life of the asset. So if the economic life of an asset is established, let's say 10 years, and you have a lease contract of 6 years, well, 6 is a major part of 10, and you have to capitalize or put the lease on the balance sheet. Okay, so any one of those guys is sufficient. Now, just to note, guys, this is IFRS criteria, which of course most countries, most listed companies in Europe and around the world will tend to use IFRS. So many countries do. Because the CFA syllabus does also can look at US GAAP, doesn't it? Just because we need to compare and contrast with sort of US standards. So US accounting, US GAAP, uses similar features as IFRS, but if we just have a look here, again, any one of these would be sufficient to call a lease a capital lease or finance lease. The first 3 points actually are pretty much identical to the IFRS standards. So guys, see that title transfers during the life of the lease, just like the international standards. There's an option to buy the asset at less than fair value. It's like a call option, right? In the money call option. Okay, the third point is not quite the same, but we say the lease period is the major part of the life of the asset. Well, the US GAAP is more specific. US GAAP says it has to be at least 75%. Now, of course, I would highlight that because that's a specific fact which I would imagine could be tested. So this means US GAAP is giving more, so we say, flexibility in terms of getting away from calling it a finance lease, because if yours is 74.5%, for example, as your asset, as your period of your life, then that would not require a finance lease, whereas IFRS is a major. Right? So this is quite cut and dry, kind of black and white, really. The last point, guys, is specifically for US GAAP. The PV of the lease is at least 90% of the fair value of the asset. So again, guys, that is specifically there for US GAAP, something we look at. But any one of those points would be sufficient. Okay, I hope that's all right. Again, I would generally recommend that you understand and know these points. They can easily test that in a narrative, question. Now, once we've understood, as I say, the amortized cost method for bonds, the good news is we're going to use the same method now for a finance lease. So the idea, guys, is accounting for a finance lease for the leasee. The leasee will use the amortized cost method. Okay, so as you can see here, nice intro, same method as accounting for bonds, which we've just done. Recognizing the asset and liability on the balance sheet. Now, as we've said, from a leasee's perspective, we are going to have the combination of an asset. We are going to have, of course, the lease payable. Okay, so asset and lease payable both are on the balance sheet, but the asset, like all assets, typically, guys, which are long-lived, will create depreciation expenses. So if I just put here, note here, depreciation expense comes from the asset, whereas the lease payable will generate interest. Like any debt, instrument there, you have interest generated on the debt. So these two will effectively be in your income statement. So balance sheet, guys, like this, excuse me, an income statement like that. We need to be able to calculate perhaps some numbers here, depreciation, interest, and also analyze how we might expect this to affect profits in early or later years of the lease. Okay, so there we go. Income statement expense. There's partly depreciation of the asset. There's partly interest expense on the liability. Now, as you remember, guys, the calculation for any interest expense is done as the opening liability multiplied. Now, we don't say the yield to maturity because this is not a bond, but the effective interest rate is what the lease has. So the lease has an effective yield, if you like, inbuilt into its cash flows, and so this will be used. So the lease rate will be told to you if you need to work out any kind of, interest expense. So we note, everybody, that you basically it's the same as before. To go from an opening position on the liability to an ending or closing position, the first thing you do is you will add on the interest expense, which is as calculated as we know, and you subtract the actual annuity, which is the lease payments. Now, please note, everybody, that having the lease payments paid at the end would mean it's called an ordinary annuity. Right? The payments are made in arrears. Okay. You can, of course, have annuities paying in advance, but most of the time it's paid in arrears. So we have that. Now, shall we try an example? We try an example. Now, the example here is regarding for accounting for a lease by a leasee. And you can see, firstly, the equipment is leased for a time period of 4 years. So it goes on our calculator now. If we start putting some numbers in, I want you to clear your old data as before. So second FV, clear the old data. And we have 4, and of course that's going to be our number of periods, isn't it? 4N. We say 1,000 is due at the end of each of the years of the lease payments. So it's an ordinary annuity. So just putting that, it's an ordinary annuity, and we have 1,000 as our payment. So we'll put that in. Then we have the rate implicit in the lease, which means the lease rate. So as putting there simply 10 as your yield or interest rate, 10 IY. Okay, now that's the important part so far. Now we note that it says here the economic life of the lease is 5 years. Okay, 5 years. And the current fair market value of the asset is 3,500. And the reason why we're told these things is so that you could at least analyze whether you think this lease should be capitalized, put on the balance sheet or not. Is it an operating lease? Is it a finance lease, right? Now, one of the things we can look at is the actual lease term. Now, we can see, guys, there, 4 years is the lease term, and 5 years is the actual economic life. So as a ratio, of course, we can say 4 years over 5. We can all work out, guys, ourselves there, but 4 over 5 is, of course, going to give you 80%. So the lease term is 80% of the life of the asset. Is that significant? Yeah, of course it is, right? IFRS says it just has to be a major part of the life of the asset. It's definitely major. And US GAAP says it had to be at least 75% of the life, which it is. So whichever way you look at it, you're going to have to capitalize the lease based upon that information. Now, if we actually work out the, if I ask you to compute the present value of these annuities, compute PV, the present value of the four $1,000 payments, should we say roughly, everybody, 3,170? 3,170. Now that is again significant, because if you were to look at 3,170 as a proportion of the market value of the lease, of the asset, which is 3,500, you'll find that this number is significant. This percentage is significant because it comes in at above 90%. Or if not, we'd say almost equal to, right? So greater than equal to 90%. Is that significant for US GAAP at least? Yes, because they say 90% is a key marker where you have to capitalize. IFRS doesn't make an assessment of that, but still. We don't need to have 2 points. We just need any 1 point out of that list to capitalize. Okay, everybody, hope that's all right. Now, we need to show the effect of these things on the financial statements. The key one, of course, is really the finance lease. So right away, we can start out with the basics. Assets, liabilities, and equity. From a leases perspective, we're going to have the asset 3170 going on. And in terms of the liability, again, the liability 3170. Okay. Operating leases don't have, of course, a reflection of the asset or the liability. It's simply a rental contract. So there, just to summarize, there's no effect on the assets or liabilities column. You'll just have an operating expense, and that's going to be equal to the $1,000 that you're paying essentially at the end of every year. Okay, now if we just take that forward a bit, look at that. You know, straight away we're back into our amortizing cost method. Same method we were using for bonds. The same method we're using for lease payable. Please note it's the exact same structure of the table. We have this time 4 periods, but still they're annuals, aren't they? Annual periods anyway. So year 1, year 2, year 3, year 4. As before, if you want to work out the interest expense, you just take the opening balance and you multiply it by the lease rate, which we were given, weren't we, as being 10%. So hopefully you can see, you know, the numbers there should match out. Yes, 3170 times 10% should be 317. Okay, so that's adding to the liability. And then the cash payment is just the lease payment. The cash payment, just the lease payment itself. In this case, we have 1,000, don't we, in every case. So take off 1,000. And that then will amortize some of the principal. In this case, if I just say, what is the amortized PRN, can we see that's going to be the difference between 317 and 1,000? Yep. 317 and 1,000. So basically, amortized principal will be 683 coming off the liability. And we can do this again and again. Now, just a word of note here. Just for the first year, you can see essentially what's happening. But for year 1, if I just take a note here, for year 1, we would note that, yes, the asset is initially worth 3170 going on there. The liability is also 3170, but you have a distinguishing feature between what is the current liability and what is the non-current. Because often, with bonds as well really, but even leases, you will split the liability into the part which is due in the upcoming period. So guys, notice in the first year we repaid 683 of the principal. So 683 goes here. The current liability is technically 683. And the part which is to be repaid later is the other part of the balance. So non-current would record 2487. Okay, just to say that we do affect current liability as well as non-current liability with the accounting here. Okay, now, as you know, guys, you could use the calculator function to work out your numbers for all of these things here. We have the usual story: interest expense, ending balance, right? And you've got amortized principal. So, needless to say, you could do that if you wanted to. Okay, now, also, guys, just to note that when you have cash flows, the cash flow operations will be just the interest component. So here, if I were doing the, for the first year, in year one again, CFO and CFF would both be affected. Cash operations would be, go down, interest is down, so interest paid would be taken out of CFO. Whereas principal, repaid if you like, is going out of financing. So for year one, we can see that 317 is the interest that goes out of CFO. We can see that 683 is going to be your principal repaid, that's CFF. Now collectively, of course, that's going to be 1,000, right? Collectively, that is 1,000 down in terms of cash. But that, whilst that matches, of course, with the operating lease, which also makes $1,000 payments, notice that CFO is less affected, but CFF is more affected when you capitalize the lease. Yeah, please note that is true. Total cash flows are the same. Okay, hope that's all right. Now, what we also have, everybody, is this note about, well, now let's make a comparison. So if I just take us firstly on the note about the finance lease, you can see that we've already written in here your interest expenses. So these numbers have just come from the amortizing method that we just been looking at. Okay, so I hope that's, these numbers will come from the, from the table over here. This interest expense is 10% of the opening liability. Just transpose that. 317, 249, 174, 90 have been put onto this side here. Same numbers. Now, generally, interest expense on the lease does reduce because the principal is reducing, and so you have the percentage of a smaller amount. The interest expense reduces. But the depreciation expense, everybody, we haven't talked about that, is typically just done on a straight line basis. And so it doesn't change. By the way, notice that straight line depreciation is with a zero salvage value. Okay, zero salvage. And so that would be 3170 minus 0 divided by 4 years. And if you check, guys, that, I think you'll find where we get our numbers from. Okay, so it does come out to 792.5, okay, as your straight line dep. But what we did is simply do 2 years of 793 and 2 years of 792. So, of course, it matches 792.5 on average. Now, if we are to show what we need to show, guys, obviously depreciation adds up to the value of the asset, as it should do, because you're taking it down to 0. Interest expense is also included here. And overall, the amount that you are expensing does come to $4,000, which is exactly the same as if you had just expensed 1,000, 1,000, 1,000, 1,000. Of course, over 4 years, it's the same overall amount. So, analysis, same total expenses, and also remember same total cash flows as well per year, but here, same total expenses in the end, but not the same expenses per year. Remember, the key thing, guys, is generally we might say in the early years, which in this case will be year 1 and year 2, you have higher expenses when you capitalize. Now, the reason is usually because the interest is quite high in the early years, so that when it combines with depreciation, you have quite big numbers going through the income statement. So big expenses, guys, means lower profits. Lower profits means worse margins. Yeah. On the other hand, we have lower expenses in the later years. Low expenses relative to the operating lease. And this is generally because the interest expense has reduced. Now, guys, you can see overall expenses are the same, but be ready to say early years, later years, which ones would be higher, which ones would be lower, okay, relatively to each other. Okay, so there we go. Of course, the operating lease, just summarizing, we don't really have to do anything except note operating payment. Okay, operating lease rental of 1,000. Of course, guys, CFO would also be going down by 1,000 every period. All right, so I hope, folks, that's all right. Now, we're going to round off our analysis just by looking at some final bits now on some ratios, and firstly, actually, some actual statements. So you can see here the effect of using operating leases versus capitalized leases. Okay, from the perspective of the lessee, keep saying that. Okay. Now, guys, what about this? If we pick the capital lease very quickly here, the capital lease will give you higher assets and liabilities. Both collectively will be higher because you recognize the PV of the lease. That's why it's going to be higher, both in assets and in liabilities. Net income in the early years, is going to be lower, whereas net income overall is going to be the same. Yeah, we agree with that. So lower net income because of higher expenses in the early years. Same profits overall because same expenses overall. Yep. In terms of the cash operations, guys, we agree the CFO will be higher because only interest paid is deducted from the CFO, whereas CFF is lower because the principal repaid is removed. That comes out of the CFF. So, one's better, one's lower. But of course, overall, everybody we mentioned, same overall total cash flows. So remember, level 1 exam questions can very easily test you on multiple different effects in an exam level. What's true, what's false? Say, is it same, is it high, is it lower? So very useful to go through this. And the last thing we're doing is just looking at the key ratios. Now, again, guys, we focus on the finance lease or capital lease. Generally, we're looking at early years here. Generally, early years. So, guys, can we see margins? Agreed, really, margins, of course, will be lower in the early years because a margin will be based upon the profits that you're making over your sales. And of course, it's not the sales which are different, but saying the profits which are lower. So lower profits means lower profit margins. Of course, that's generally going to reverse in later years, though. As profits go up, generally the margins will get better. Asset turnover, everybody, is to do with the actual, as you can see there, sales of our assets. So the main thing is the sales, again, is not affected, but because assets are higher, it's going to make the asset turnover lower. You see that there. So lower because of higher assets. What about guys, the current ratio? We have a tricky one. The current ratio, guys, is basically a liquidity measure. How much assets do you have in current inventory and receivables and cash to pay down your sort of current payable amounts to your suppliers? Well, it's lower simply because current liabilities are higher. Now, if you remember the reason, it's because you show the amount you are amortizing in the upcoming period as a current liability. So as a finance lease, you would show some sort of current liability. It does drain the ratio, bring down the ratio. Debt to equity, guys, there, nothing affecting the actual, or should I say, well, actually effects on both sides, really. Higher overall because debt, of course, is included. Debt is higher, and generally earnings will be worse off in the early years. Equity is lower, so overall that's got to be, of course, a higher ratio. Return on assets, guys, key thing there. if we just mention, earnings after tax will be lower and assets will be higher. So that should obviously make sense there. It's going to be a lower ratio. In terms of return on equity, okay, we've got to be careful on this one. Of course, earnings after tax is lower. And we said that equity, guys, which basically means retained earnings, is also lower. But the earnings after tax effectively dominates. So I'm putting a bigger arrow on the earnings bit. Overall, the ratio is going to be lower because earnings drags the ratio down. Now, it's like the smaller number on the top is more affected by a big expense than a big equity capital base would be affected. Yeah? Relatively speaking, the top is affected more. And the last thing, guys, we have is interest coverage, which, as you probably know already, is EBIT divided by interest expense. And of course, really, it's about just these big interest expenses that you're putting through, which operating lease doesn't have. Brings the ratio down. So again, everybody, it's about being comfortable with making that kind of analysis quickly and accurately, and you can score a lot of, good, easy marks. Right. So guys, that brings us to the end anyway of our slide presentation on accounting. And what I want to round off really with is simply why Fitch Learning might well be right for you in terms of helping you with your studies. Certainly you can see that we have all sorts of ways of learning for our delegates. I mean, some people like classroom learning. They come to the classroom. We can help you there. Some people don't want to come to a classroom. They want to learn via themselves, distance learners, online only. We have that too. And actually, in terms of our distance learning, we have a new learning tool called Cognition, which, guys, is adaptive learning. So it basically is molded towards your studying, your ability level. If you're struggling in an area, you get more support and assistance and more questions. If you're flying through an area, you get to move on to something else. It's very clever. It's focusing on your actual, your study level. We have lots of materials. We have an app as well, which you can study then on the go, guys. iOS, Android phones, applicable. We also have the one of the largest faculties of CFA constructors around the world. So you can see they're 20 plus full-time instructors, which are all accessible via a help desk system. And especially, of course, guys, in the last month or so, when you are just focusing on questions, it's nice to know you have so many people who you can ask. Okay, you can access our team via our global help desk. So we have offices in Singapore, New York, London, Toronto, etc. You can access them all through the global help desk. Okay, guys, beyond that, essentially the slide packs, you have sort of a taste of that. You'll have sort of all the areas covered like that, as we've just seen this, in this last hour or so. Also, revision tools, so mind maps and countdown revision guides. These are just helpful ways of summarizing the core information when you basically get to that last month. And I have a question here. Do we have any mock exams or a question bank? And the answer is a firm yes. For example, 5 mock exams effectively are available to our delegate audience. We would make that essentially available in the sort of the last month or so. There is a very extensive question bank of around 3,000 questions for level 1. So the answer is yes. I mean, I personally want to have lots of questions as a student, and we focus on giving you obviously quality as well, but quantity too. So yes, we have mock exams, and we have a big question bank across the curriculum. So guys, again, just to reiterate, this new learning tool called Cognition is available now. Okay, we've spent a lot of time on it the last year. It's available now. It's an adaptive platform which will monitor your performances. So, for example, if I've got say 50 questions on say FR&A, if I'm scoring brilliantly, I get all the first say 10 or 15 right, the Cognition realizes that I am ready and able to basically move on to the next topic area. So I don't have to effectively waste my time doing more questions on the same bits and pieces. I can move on. It ascertains weaknesses and delivers tailored content. So basically, it prompts you to watch a video if you're struggling, or to maybe to ask a help desk query. Okay, so again, guys, a question here: how many full mock tests will be available? Well, from Fitch Learning, it's essentially 5 mock exams. Okay, 5 mock exams will be available. Instant access, guys, questions. So you can watch videos, you can do questions, all very easily through our portal. And I say, if you want to even have a go and play around with this stuff, guys, please look at this site here, the address at the bottom here. So fitchexamprep.com/cognition will give you access, free trials, unlimited access to quants. So, you know, you're looking at discounting and NPV, IRR. Have a look, see if you like it. You know, this is really what we can offer you. So, you know, that's totally, even if you don't go ahead with anything else, makes sense to look at that, doesn't it? Free trial, unlimited access. Now, guys, wherever you are watching around the world, we have all sorts of study options for you. Day classes, evenings, weekend study. We have intensive 5-day classes, review, which are typically 2 days, and mock exams, as I say, are available from us as well. And there are still places available for courses in London and Dubai, the intensive 5-day versions. I'll give you the right contact details in a second. There are review classes, which are 2-day review, question-answer sessions, which either can be done on a Saturday and Sunday, or they could be done during 2 weekdays. That's across all the regions, really: London, New York, yeah, Toronto, Dubai, Singapore. And we will be making, guys, new mock exams available to buy. That's going to be launched in mid-April. And all of the sort of intensive programs, the intensive courses, does include access to our full online study portal, as well as a mobile app, and also 1 mock exam. So you will certainly get access to a mock exam just by going and booking the intensive course. More information, all of that, guys, is available from fitchexamprep.com. Okay. You can, guys, do that. You can visit fitchlearning.com or to book online. Alternatively, you can contact the relevant numbers that I'm going to give you in a moment directly. So there we go. So there's regions there. Got a question: do we have any review courses in mainland Europe? Good question. I would say, if you can, just get in touch with client services at fitchlearning.com. I don't believe we do have that, but I won't want to confirm. Please do just contact client services and find if we do have anything running in mainland Europe. They'll be able to tell you. Okay, but otherwise, guys, if you have interest in booking something in London or booking in New York or something around the world there, please do contact the relevant office and go ahead. Like I say, demo our materials. Totally makes sense to do that, whatever happens. And I have a question here: how much do I need to know to be ready for a review course? Well, guys, a review course is really the last hurdle. So you need to be exam ready when you come to a review course. I mean, what it is trying to make sure your timing is right, to make sure no gaps in your knowledge. It is going to be in the last 3 weeks before the exam that we run these things, and it is really now you should be on track. You should be ready to go to the exam tomorrow, really. So certainly, almost ready for the exam when you come to a review course. And what it's there for is to make sure there are no issues that you're worried about. We do cover everything in a review course, no gaps. We even go as far as going through the ethics, which is not easy to do in a classroom environment. We try to make sure that you understand the nuances of ethics questions as well. So we cover everything in a review course. And guys, if you're not convinced, you want to hear what past delegates have had to say, then hopefully you'll see some good testimonials on this link here to inspire you to go ahead and use us in the future. Okay, now guys, just to say that this is one session finished for the day. I hope it was informative for you in some way. We are going to be having a webinar in the near future. This one is going to be run out of Dubai, and as you can see, it's a sort of practical guide to exam strategy and last-minute tips to maximize your chance of success. This is coming from like experienced practitioners, so I think it's really useful to log in and watch that if you can. It'll happen on the 26th of April, okay, and you can see the times there, whichever region you're in. See if you can watch that if you can. I think it'll be very useful. Okay, and alternatively, join us in person. That'll actually be happening on Tuesday, the 18th of April, as well. If you'd like to be in part of that, get access to that, guys, this is the right link there, the right site then to register your interest at. Right, guys, so I want to say if there are any other questions that you have, I'll be happy to take those questions now, as we have come to the end of our presentation. So thank you to all of you who were watching. Appreciate your company and appreciate your questions, and I wish you the very best of luck with your studies.